Welcome to the first episode of our World Cup series. With Vancouver being one of the host cities for the 2026 World Cup, we thought there'd be no better time than to explore something we've been thinking a lot about lately, and that is, what can soccer teach us about investing? Over the next few months, every couple weeks during the tournament, we're going to have short conversations unpacking different ideas from soccer and connecting them back to markets, psychology, competition, and most importantly, investing. Because the more we thought about it, the more soccer started to feel a lot like markets. Messy, emotional, adaptive, unpredictable, but still structured underneath. Also really interesting to spend way too much time thinking about. So joining me today is our resident soccer fan, Felix Narhi. Felix is focused on uncovering differentiated opportunities across North American equities and was previously served as Pender's CIO. He spent decades thinking about business quality, market structure, and long-term investing, as well as following soccer, which makes him the perfect guest for today's conversation.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, penderfund.com/disclaimer.
Felix, welcome to the podcast.
Thank you so much for having me.
So, like any great conversation, I wanted to start off with something a little bit weird, and I was wondering if you could explain it to me. Whenever I've watched a soccer game and I see one of the penalty kicks, goalies, they almost never stay in the middle, even though mathematically they probably should. When I think about like a hockey shootout, if I just saw a goalie jumping or gliding dramatically to one side, that would be crazy. So it seems like one of the craziest statistical quirks in sports. Can you explain why this is and how this kind of relates to investing, maybe?
Yeah, for sure. It is pretty fascinating, actually. And I do believe that there is this kind of crossroads between soccer and business and psychology. And after all, it's a human endeavor. So it's pretty, there's a lot of similarities there. But yeah, ultimately, a number of years ago, actually, researchers actually looked into the same question, just trying to figure out, how should goalkeepers sort of optimize their save percentages and what have you. And, what they noted was that on average, when a penalty kick was taken, usually about a third of the time was left, a third center, and a third right. So pretty much a third to third, not exactly, but that's roughly what happened. But what they found is what goalkeepers actually did, and this was across, I believe it was about 311 different matches that they studied. On average, they went either left or right 94% of the time. So, essentially they never stood in the middle, even though like a third of the kicks were on average in the middle. So again, if you were going to take a shot, you probably should take it through the middle because the goalers have this they're going to go either side. And the other thing is that on average, the shots that did get shot in the middle, if they stay in the center, they saved about 60% of them. So that's a pretty high percentage. So if you jumped left or right, even if you guessed correctly, you wouldn't get 60%. So really the optimal thing is usually at least to stay in the middle, at least a third of the time. So this wasn't the case. So then they went and talked to these goalkeepers. I think there's like 32 different professional goalkeepers, and they were asking them why do you do this stuff? And essentially what the answers essentially boiled down to was they wanted to minimize their regret. So it was really sort of like this bias for action because they just felt like they just didn't want to feel like they did nothing. And of course, they should have done nothing much of the time, not all the time, but much of the time. And so this is sort of like this sort of is sort of these ponderies of soccer, and it sort of matches a lot what happens in investing too. So it's an interesting crossroads when you think about it.
Yeah, no, it reminds me a lot of kind of how important the psychology is just within sports as well as within investing, is kind of the perception of others and the perception of not doing something weighs so heavily on kind of strategic or logical decision making. Like even when you actually have these goalies must know the stats, like they're performing at the highest level. They know that the shot's going to go in the middle a third of the time, but to consciously make that decision over and over, knowing that it's statistically incorrect, is really interesting to observe.
Yeah, oh, for sure. And I think it just goes down to your point, sort of a, behavioral, finance or just behavioral. It's, I think humans have this sort of bias for action, there's that famous kind of saying, like, don't just sit there, do something. So we're all inclined to do something, especially when there's the pressure of the situation and people are watching you. You don't want to look silly. But much of the time, actually, you should kind of inverse that thinking and that psychology. And it really should be like, don't just do something, sit there. So again, this is not to suggest that you shouldn't do anything. It just means that sometimes the rational decision is actually to do nothing, and the decision to do nothing is actually still a decision. It's not like you're not doing anything. You've just decided that actually sitting on your hands and not doing anything in this particular moment is probably the best outcome. And especially when markets get really crazy, when there's a lot of volatility out there, I think there's definitely a bias that people should do something during really scary periods. And ultimately what that results in is sort of selling low and buying high. I mean, that's one of the big issues, I think, of investors is that, there's so much psychology that drives action that, when the world seems the worst, you essentially, instead of buying more, buy when others are fearful, you just kind of fall into the trap. And I think that's why a lot of, advisors tell their clients, to stay the course during those periods. And it's really important just from a psychological standpoint to not freak out during those periods. And, most clients, I think, and folks that kind of do stay the course actually in hindsight are the ones that are the long-term winners. But again, it doesn't mean that you're not doing anything. There's lots of opportunities. And at Pender, I think we embrace volatility. Like, the best opportunities when the investment team gets most excited is, in those periods where, some Trump tweet basically unleashes more chaos, essentially. And, from a long-term perspective, it's an opportunity and not something to freak out about. But again, it's sort of like how you approach, those things and how you think about being patient and doing stuff and being sort of counter-cyclical.
Yeah, because I think it's an important distinction is when you think of things like, I don't know, like a value trap or like a sunk cost fallacy is you've invested X amount of time already that you're so incentivized to do nothing. And that's a little bit of a different psychological way of thinking about it than making an active choice to not do something.
Well, for sure. Yeah, I think the whole distinction between, being patient and then being stubborn and falling into a value trap, it's a fine line. Certainly professionally, I think any investor and myself included have fallen through that trap at times. So I think there is some ways to maybe overcome that. Like there could be some automatic rules, for example, that you could eliminate these sort of like holding on because it's too cheap to sell kind of things. I mean, one of the methods that we kind of classify ideas, certainly on the equity side, is kind of, close the discounts versus compounder, emerging compounders. So, close the discount is really companies that aren't really creating a lot of value, at least at a sufficient pace to be long-term investors, but there's a huge gap in, what the stock price is and what it should, what the intrinsic value is essentially. So you have to close that gap. But there's a lot of companies that, stay cheap forever, and there's actually no closing of the gap. And so simply buying a cheap stock with no catalyst or no way to close that, and being stubborn about it, and that underlying value never changes over 2, 3, 5 years, and you're still holding on to it. I mean, that's a definition of a value trap, right? So, an auto rule that could help, which, for example, Ben Graham did, the legendary value investor that Warren Buffett studied under, was he kind of had this, or one of the rules he had at one point anyway, was this 3-year rule. So essentially, he'd buy these net discounted stocks back in a way different time when those were, a lot more readily available. And he basically waited for the stocks to either go up 50%, close to his intrinsic value, or 3 years, whichever came first. So again, if the stocks didn't kind of get to his thesis over some kind of reasonable time, 3 years, I think is plenty for those type of ideas to actually work out. You got to move on and admit that you made a mistake, and you don't have to make your money back the same way you lost it. And so I think that's one of the most important lessons. And by having some automatic rules, like for example, for those type of ideas, the 3-year rule, at least you're not handcuffed forever stubbornly to these value traps, because psychologically it's easy to fall into them.
Yeah. So it's, I guess, similarly making the conscious choice as the goaltender as time goes on, that sometimes you're jumping left, sometimes you're jumping right, but also understanding when sometimes that the center is the place that you should be.
Totally. Like understanding your biases, right? That that you have this bias to act, but also know that your bias to act is actually producing worse results than not doing anything. So just trying to be a bit rational, introduce rationality into your thinking, and maybe just create some rules. Like maybe the goaltender will say, out of these next 5 penalty kicks, I'm going to have at least one that I'm going to stay in the middle, or maybe 2 at least, and he'll decide which one of them they are, and that will kind of create some automatic rules so that he doesn't sabotage himself.
Yeah.
Or herself.
Yeah. No, it actually, that kind of leads in well of another point of this penalty kick idea that I've always found sort of interesting. And it's across sports, is in all these really dynamic games, like whether it be hockey or whether it be soccer, there's so much going on, and there's a lot of decisions that the goalie is going to have to be making, analyzing where on the pitch the ball is, where the defenders are. But then when you get into these penalty kick moments, there's a lot less going on. It's a pretty discrete decision of left, right, or center. It's kind of another way of thinking about markets, is when is it important to be analyzing the big picture and having an idea of what's going on generally, and when do you have to make that kind of quick, binary choice between 2 or 3 options? How do you sort of think about that distinction?
Well, that's a great point, and I probably a good kind of lead into maybe another kind of related topic is sort of classifying sports and business activities into sort of discrete and continuous. And certainly overall, I'd say soccer would fall more into the continuous, and by that I mean there's sports, like baseball, golf, that are sort of there's brief moments of time that are discrete where the action really occurs, and it's almost, you can be very statistical about it. There's not a lot of different patterns that can emerge that are not necessarily related to continuous. And so the whole goalkeeping example actually probably within soccer would be one of the more discrete examples. So statistically, you should do this and that. And baseball, for example, is famous for being one of the most statistic heavy of the sports, but that's because it's discrete, and it's somewhat similar to businesses as well. There's some businesses that are more discrete, more predictable, like utilities, telcos, etc. You can do a lot more of the analysis sort of in a more structured way, statistical way, looking at, returns on invested capital, asset turns, all these kind of things that I think are quite useful. On the other hand, there's a lot of kind of emerging, small cap or tech companies, venture companies, where you just don't have that kind of discrete behavior. Like any decision by a customer or a CEO to launch a new product line, or possibly take over some assets or whatever, can completely change the game. And there's really no return on invested capital discrete way of analyzing that. So it requires a totally different skill set and way of thinking about it. And so, similar to sports, again, I think it's there's analogies there, and overall, like, yeah, there is, I think, two components in the soccer, the beautiful game. There's a continuous aspect, but also, as we talked about, that discrete aspect. And certainly some of the stuff that we do here on the venture side, more small cap side, tend to be more on the continuous side, right? I mean, there's less rules, and there's more dynamism that basically happens when you're analyzing these type of companies. And then the more mature, kind of predictable companies, I think, are much more rule bound. And again, they just require a different kind of skill set.
Yeah, and I also think one of the other more psychology related frameworks, like the idea of thinking fast and slow, and when do certain businesses, and I don't know, certain, whether it be penalty kick or the context of the whole game, require those quick decisions where there has been a tweet of some sort, or there's another war where you do have to make kind of immediate judgment calls versus kind of sticking to those long-term frameworks of understanding the overall soccer environment, but also business environment too.
Oh yeah, for sure. There's, I mean, the macro is interesting. I've always had this thinking, macro is always extremely important. The issue I have with macro, and again, speaking of a continuous game, there's nothing discrete about macro. Everything can change, or a war, or the Strait of Hormuz, or what have you. But macro is one of these things that I believe is important, but it's largely unknowable. There's so many, like, it's difficult enough to kind of understand a particular company, and where the kind of critical points of the thesis might break essentially. But the macro is basically all that and everything else. I mean, there's so many. Speaking of a continuous game, like, it's so complicated and so multivariable that it's essentially, largely impossible to sort of like create investment strategies, I think, around that. Maybe others people can do, but for me, I just think that's very complicated. And again, it's hard enough to be a reasonable expert on a particular industry or a particular company. But for sure, like, it doesn't, I think overall the overall market and macro probably controls, 50% of stock moves, and, the industry probably, controls another 30%, and 20% is alpha of the individual company. And the individual company does matter long-term, but over long stretches, all those other things, which many of them are kind of unknowable and very frustrating because the companies get swung back and forth because of this kind of stuff. Yeah. But there's really not much you can do, I think, as an investor. Like, sometimes it's just best to, going back to, like, don't just do something, sit there.
Yeah, no, and maybe that's the real lesson that we learn from the beautiful game, as you said, is that it's not just unpredictable or hard to understand, but that different systems require different frameworks of thinking. And some environments, they require that precision and models and that idea of, okay, 1/3 of the time I'm going to stay in place. But then other times the game rewards adaptability and judgment and that innate goaltender sense that we've all kind of experienced, if they just knew that the ball was going in that direction. So
yeah, oh, for sure. I think generally speaking, especially when things get really crazy on the sort of pessimistic side, I mean, I think people generally underestimate two things, and you actually kind of hinted at one of them. I think people underestimate the ability to adapt, right? And so management teams and investors, I mean, the world's constantly changing. So however you succeeded, 10 years ago or 20 years ago, like, you better be adapting and looking at new tools and ways of thinking. But there also is, at some level, reversion to the mean. So, like, the bad times don't stay bad forever. The good times don't stay good forever. Like, the world's cyclical. There's a cyclical aspect to markets, essentially. And so there is this sort of like constant fluctuation. Like, there is a little bit of a trap of you getting like, well, the fair value is this, and it's kind of like this pinpoint answer, and it's not really a pinpoint answer, and you'll find the market doesn't care. It just slices right through your pinpoint answer anyway, because of all these other inputs on it. It's quite humbling. But there is a range someplace in there, and then when markets get particularly emotional, I mean that I think is a huge advantage of a rational, patient investor. I mean, ultimately, I think you want your counterparty on the other side of the trade to be, completely crazy, irrational, and manic depressive, right? Things get bad. You want them to get like totally manic and the world's going to end. I just want to blow this asset out. I don't really care. I just want my money back right now. And on the flip side, when you have the greatest, AI, whatever, thingamabob, they'll just pay almost any number for it. And then, if they want it that bad, you should sell it to them probably, right? So understanding again that there is, this sort of reversion to the mean. So I think those are kind of two powerful ideas that really help you get through kind of the highs and lows that are just inevitable part of this game and investing.
Yeah, and I guess maybe the best investors are the ones that really understand like what game they are playing and what market they're really operating in, and just having that patience to either make the jump or stay put and stick to the plan. So
Totally. You have to know your game, but be adaptable when the world changes as well, right? And I mean, I think there's a book written a number of years ago, investing is the last liberal art. And, it is such a fascinating game. Like there's so many aspects of it, psychology or mathematics or finance and learning about business or, all this kind of stuff. Like it's, it's one of the most interesting, the things I can imagine doing essentially, right? Because it's not, and things are constantly changing. Like if you're a curious person, it's so fascinating. And so, you're always learning. So if you're not constantly learning, I think you're essentially falling behind.
Yeah, no, I definitely agree. I think what drew both of us into this, there's not a lot of other industries where you can draw parallels between sports and what you're doing in your day to day. So I'm definitely lots to learn constantly.
Keep on learning.
Yeah. Well, Felix, thank you so much for joining us on the first episode of our World Cup series.
Thanks. Pleasure. It was a real fun conversation.
Yeah. And thanks everyone for listening. We'll be back in a couple of weeks with another World Cup conversation where we'll explore more ideas around competition, investing, psychology, and the complex systems through the lens of soccer. And as always, you can follow our ongoing commentary at the Pender Pulse on Substack. See you next time.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at penderfund.com.